Hi everyone, it's Jack back with another video. Today I'm going to be talking about Starbucks. Starbucks is a business almost everyone knows or at least has some exposure to. By far the biggest coffee chain in the world and almost a verb for getting a coffee at this point. Now a $107 billion company. Stock has taken a big hit recently, down 26% from its highs in July 2021 to a yearly low of $93. I want to work out, is it cheap or has it still got some room to go down until it hits a fair value that would be acceptable to pay? Starbucks has seen some really monster growth over its history, now $29 billion in revenue, steadily climbing for years. This graph, so the last 15 years, you can see it's grew dramatically. The global coffee market is expected to eclipse $400 billion in the next 3 years, while Starbucks has $29 billion in revenue, representing an 8 to 9% compound annual growth rate over that time. This is a respectable growth rate for any sector, but Starbucks management actually believes they can surpass this. Their long-term growth rate has surpassed this. With their scale and vision, they think they can grow even faster. I actually believe this because of its strong brand. It's just massive economies of scale. It's a huge marketing budget. I think they'll manage to do this, but only time will tell. In the most recent quarter, Starbucks actually reported some pretty strong numbers. Revenues up 19%, again on pretty weak comparable numbers. Comparable store sales up 13% globally, decent, 18% in the US, which is a pretty strong number with a 12% 2-year growth rate, so from at this stage 2020, which is again quite decent. China now has 5,500 stores and is still growing. China's long been Starbucks' biggest growth market. They really targeted it in the early 2000s. Global stores now just over 34,000. These are great numbers, some of the highest for any restaurant chain. I guess Starbucks isn't really a restaurant, but that's some of the highest for any restaurant chain in the world. Really important, the active reward members, Starbucks reward members in the US, up 21% year over year to 26.4 million, and that's just active members. Loyalty programs are so powerful in helping build moat by incentivizing returning to Starbucks specifically rather than another vendor. It's just one of the ways that Starbucks builds up a powerful network and a powerful moat. Starbucks recently raised its prices again for the third time since October. Of course, this is due to inflation and wage rises, but the key here is that Starbucks is able to do this due to its incredible brand and therefore pricing power. Starbucks is easily the biggest name in the game, and the ability to raise prices is a classic sign of excellent moat. Taking a look at some of the fundamentals of the business, the balance sheet and the profitability metrics, cash debt ratio of 0.17 is pretty weak in my opinion. As the most recent filing, Starbucks has around $23 billion in debt on the balance sheet. This is quite high. Compared to the market cap of $107 billion, it is not intolerable in my opinion. This debt is quite clearly being used to expand the store count. As long as this remains within reason, as they do, they grow the store count at not ridiculous rates every year. And as long as this is at a reasonable debt to EBITDA ratio, which I think 3.13 is a reasonable ratio, I'm okay with this. The company has been assigned an Altman score of 2.99, indicating that the company is not at immediate risk of financial default, but is not a great score, indicating there is a degree of risk here, which I think is obvious. Has good interest coverage. All of these numbers are quite weak for Starbucks' history, indicating they're trying to expand quite aggressively and spending a lot of cash and generating debt. I'm kind of okay with this debt because I think it's being used in the right places. If it gets any worse, this will be a sign of concern for me. I'm giving it a let off for the debt really because its net margins and operating margins are very, very strong for this industry. Starbucks owns its restaurants rather than franchises like other providers such as McDonald's. And for this model, 14.5% net margin and 16.09% operating margins are very, very strong and pretty good for Starbucks' history. Net margin of 14.47% means it takes home 14.47 cents for every dollar. On that's $29 billion of revenue every year. That's quite a lot of earnings taken home. Return on assets of 14.84% is again very strong for this industry. I would typically expect between 5 and 10%, so 14.84 is very, very strong. And overall, I think these profitability metrics, as they've kept up for many years, are very, very strong, and I can see these growing in the future. Taking a look at some basic valuation metrics, there's really only a couple of these that I'm not interested in. By many metrics, the stock is the cheapest it has been in a long time. Of course, it is not growing like it used to be, so this is to be expected. It's much more of a mature company now. Price-earnings ratio of 25.58, some of the cheapest it's been in its history, and it's about the S&P 500 average now. This indicates that the market believes Starbucks will give only market returns. Of course, the market is slightly inflated at the minute, but this is the reality. This price to earnings ratio is one of the lowest values seen for Starbucks in recent years, as is the price to free cash flow of just 25 and the PEG ratio now 5.22. Starbucks has always traded at a significant premium. Clearly, Starbucks is cheap relative to its recent history, but is it and perhaps expensive versus its industry peers? But it deserves that because it has a fantastic record compared to industry peers like Dunkin' Donuts, for example. What I want to know is it cheap based on its future earnings potential, which is obviously the most important because past results are not indicative of future results. So to do this, we must do a discounted cash flow calculation to work out an intrinsic valuation, a fair value, and something we're willing to pay with a reasonable margin of safety. I've used earnings per share numbers here because the free cash flow numbers are absolutely all over the place. An enormous gain this year because they basically had no free cash flow last year. So I'm using earnings per share numbers because these are far more realistic. Over the last 10 years, they've grew earnings per share a staggering compound annual growth rate of 26.4%. I do not believe they can keep this up. I think the earnings per share growth will be much more in line with the 10-year revenue growth of 12.3%. Perhaps optimistic earnings per share number I've entered into the calculator is 15%. Earnings per share has obviously grown at a ridiculous rate recently. I believe that earnings per share in the future will grow right in line with revenue, 10 to 12%, and then will be propped up by share repurchase to a rough 15% earnings per share growth a year. I think this is a realistic number going forward. I've used an 8% discount rate for the long-term returns of the stock market, and this gave, based on the current stock price today of $94, this gave a fair valuation of $110 for the company. So a bit of a premium, not a huge premium, about 20% premium over the current stock price, but it is a 20% premium. That is a significant discount to the fair value of the stock. Overall, I think it goes without saying that Starbucks is clearly an excellent company that's entering now its more mature phase as a company rather than its growth phase. I don't really see any headwinds going forward. The company is clearly exercising its excellent pricing power with 3 price rises this year. It has an amazing brand, continues to grow its store count outside the US rapidly to give it some extra growth, and actually has some optionality, I think, with the potential for more partnerships in the future, and potentially revamping its quite poor food offering. I think the food offering from Starbucks is really subpar, and it's proved this over time, and they need to grow that ticket growth in the future, and I think food is definitely an option they could do. The stock trades at around a 20% discount to its calculated fair value, with perhaps my optimistic earnings per share growth rate, which I don't actually think is optimistic, but some may. With more conservative numbers, it's probably about fair value or slightly below. I believe Starbucks is a great company trading at a decent valuation and will be a much larger company in 10 to 20 years. It's been a fantastic stock to own. I think it will be a fantastic stock to own for the future. It's just not going to blow the doors off with its growth now. It's a $100 billion market cap company. I'm happy to buy in at these prices. I'll be dollar cost averaging, hoping the price goes a bit lower actually, while it remains below my calculated fair value. I'm not sure if this is going to be the bottom for Starbucks. I very much doubt it because I think the indices have perhaps 10% to fall. But I don't really care. I'll be dollar cost averaging over the long term. And as for many long-term investors, I think this is a great entry point for Starbucks. But of course, this is not financial advice. If you want financial advice, you speak to a registered financial advisor. And of course, do your own research. Thanks.